Next, let's talk about trade position, size, and risk. So position size is the number of units of a financial instrument a trader purchases. This could be shares, crypto coins, forex currency, etc. With the use of a stop loss, we can measure the amount of risk we take on per trade. And the risk per trade is the percentage of total equity the trader could lose per trade. Total equity being their total capital or the total size of their trading account that they're using to enter that position. Now, this is subjective, but most traders are comfortable in the range of risking 1 to 5% per trade. Now, generally, anyone is free to do whatever they want, but generally 1 to 5% is safe levels, considered normal in terms of what people are risking. Professional traders, what they risk on a given position. Some people may opt to choose more. For beginners, we suggest that you stick with a 5% trade. So new traders don't risk anything more than 5% on a single trade, with the stop loss set 5% lower than the entry. If you feel that your position could go well, but you feel like you'll be invalidated at 10%, perhaps it would be better for you to look for a better position or just a closer entry to that invalidation point. That way you really are managing your risk. If you take a 10% hit on your trading account, that could set you back quite a bit, especially for a new trader who's still learning the ropes. Now, to calculate the risk per trade, we would multiply the total equity by the risk percentage. So let's say we have a $10,000 trading account. This is our equity. We want to risk 5%. 10,000 times 0.05 would be $500. So for every trade that you're risking 5% with that $10,000 trading account, you are risking $500. Now, if the trade idea is wrong and the position hits that stop loss, the trader limits his or her loss to only 5% or $500 in this case. And notice even if it's $100,000 and you're risking 5%, that would be $5,000. If you're trading $1 million and you're risking 5%, that would be $50,000. The main thing to focus on is the percentage. The numbers, the size of the trading account, they'll change, they'll fluctuate, but the percentages typically will remain the same. Those are our constants. So really, we're only risking 5% of our position in case something goes wrong. Now, if something goes right, we stand to gain much more than 5% if we're balancing out our risk to reward ratios, which we'll talk about in a little bit. Now, the risk to reward ratio, R to R ratio, this measures the ratio of how much risk you are taking on compared to the potential reward. What are you going to get out of that entry, out of that trade? To calculate the risk to reward ratio is simply the reward divided by the risk. Here's an example. Trader enters a long position with a stop loss. They're risking $50 below entry with a profit target, the reward of $200 above the entry. So here we're not talking about specific entries. All we know is that their stop loss is $50 below their entry and their profit target is $200 above their entry. So we can calculate that as $200 as their reward, and they're risking 50. That gives us a ratio of 4R. So for every 1 point of risk, or every dollar that is being risked, they stand to make $4 as a reward. Now, this is formulated by factoring the position size. This is the price where you enter the trade. The position close. This is the price where you would take profits or sell if successful, if your trade idea plays out the way you wanted it to. the stop loss position if a losing trade. Now, it's important to remember, good traders have their entries, their exits, their profit targets, and their stop loss all pre-planned before entering a given trade. They already have that set up. They already have all of these set up. They have their stop loss set up. So, even if they go to sleep at night and the trade goes wrong in the middle of the night, they wake up, they didn't suffer a 20% drawdown. They didn't suffer being stuck in a position for a month or 2 months or even longer. They only took that 5% hit or whatever that percentage was that they set their stop loss to. Here's another example. So let's say Drew wants to enter a long position on Ethereum. Drew determines that he wants to take profit when the price of ETH reaches 15% from his entry. So he's looking to make a 15% reward on his entry, 15% gain. He also determines that his position would be compromised if the price falls 5%. So he places his stop loss at 5% below his entry. With the profit target set at 15% and the potential loss set at 5%, the risk to reward ratio in this scenario is 15 divided by 5, 3R. So for every dollar he's risking, he's aiming to gain $3. So it's a 3-to-1 risk to reward ratio, 3R. For each unit of risk, Drew's potentially running 3 times the reward. So for each dollar risk, Drew once again can gain 3. If Drew has a position worth $100, he risks losing $5 to potentially gain 15. Now, if he's using a $1,000 position, he's risking $50 to gain $150. A 10,000 position, he risks $500 to potentially gain $1,500 profit. Now here's a note on risk reward. The settings of risk reward should be situational. There's no set minimum or maximum risk levels. It's subjective. It varies trade to trade. It really depends on the setup, the asset, the overall market environment, and really what is being presented to you. Really, the only thing that's fixed in trading is the fact that the market will change. It can and will change, and you really have to adjust what you're looking for, adjust your trading style and your parameters based on what is presented to you in front of you from the market. Now, with that said, beginners, people who are new to trading, people who are new to risk management or stop losses, I know way too many people who don't use stop losses, they may want to stick between 1 to 5% risks and not risk any more than 5% on a given position. I personally don't like to risk more than 5% on a given position unless there is severe upside and I'm very confident and extremely confident in the overall market, and there's things suggesting that there is a very high probability of me being right. Now, if that is not the case, but I'm still feeling confident in the move, I would not take anything more than a 5% risk on a trade. But that's just me personally. You can do whatever you want. It's not financial advice, but that's just something that I do. Another thing to consider, entry and exit points should not be calculated based on unreasonable numbers. We want to have realistic targets on what we're trying to get out of our trades. Always go into a trade with a fully thought out trade idea or an analysis backing your claim. Where will it go if I'm right? Where will it go if I'm wrong or invalidated? Be realistic, right? But we saw that example before with Ethereum. Most likely, Ethereum is not going to shoot straight up to 4,800 in one candle, right? There's significant levels of resistance and price levels that need to be overcome and conquered and turned into support before we can continue onto the next level, the next price level, the next trading block, if you will. I try to think of them as steps, right? We need to climb the steps. We can't go from the second floor to the third floor and all in one step. We have to take step by step and climb that ladder, climb those stairs of price. Now, if the trade has high risk, it may not be best to try to alter entry, exits, stop loss positions, but rather look for an alternate trade setup with a superior risk to reward ratio. Like we said before, if we see this potential trade, but we're risking 10% or more, it's most likely not a good trade, right? Most likely, especially if you're a beginner, if you're inexperienced, it's most likely not a good trade. It's not advised. I would just look for a better setup. There's always more setups. They always keep coming. There's no need to rush into trades or force a trade or anything like that. Just wait for the right setup to come. And when you see it, you'll know and you take advantage of that. Now, positions with varying sizes can have the same risk to reward ratio. Doesn't matter if Drew trades with $100, $1,000, or $1 million. The entries, exits, stop losses, and risk reward ratio are not affected by the position size. These are all based on, especially with stop losses, profit targets, risk reward, it's all based on percentages. So once again, the percentages stay the same, but the position you're trading with, the amount of capital you're trading with, that will fluctuate. Now here's a visual example of risk reward ratios. Once again, here's similar to our trading tool that we found on TradingView that we were using before. Here's our entries, and our entries are the green would be our profit area, or the top would be the target price or the profit target, and the red would be our risk area, with the bottom line being our stop loss set. And here we see three different examples of risk reward ratios, with the left one being a 2-to-1 risk reward ratio. This is considered high risk, where you are taking on 2 risk for every 1 reward, whether that's percentage, dollars, it doesn't matter. That ratio, we're leaning very heavily on the risk. And as you can see, we're taking a lot of risk for a chance at a low reward. Not necessarily a great setup. In the middle, here's a 1-to-1. So this is a much more balanced one, where we see a 1-to-1 risk to reward for every dollar or percentage. Risk, we're seeing $1 percentage or point taken as possible reward. Here's a balanced trade. I still personally don't like to take 1-to-1 risk to reward ratios. I want to take positions that are favoring the reward. I want to be more likely to make out with that reward and really have way more upside, or whatever my direction is, whether I'm longing or shorting. I want it to have way more space in that direction. If I'm longing, I want to see way more upside. If I'm shorting, I want to see way more downside potential, as opposed to the market having way more room to go against me. And here we see a 2-to-1, a 1-to-2 risk reward ratio. So for every point of risk, we see 2 points of possible reward. Low risk, we have much more to gain, and we have our stop loss set here. So this is considered a tighter stop loss because you don't necessarily have a lot of wiggle room, right? You don't have too much room in terms of room compared to your target profit. So this does depend on where you're setting the stop loss, but the main idea is that you may find that it's more optimal to prefer lower risk trades, especially in the beginning as an inexperienced trader, someone who's learning the ropes. It's suggested you stick with lower risk trades and really try to find those better entries. So here's an example of a trade. This is Bitcoin US dollar, and this is on the 1 hour chart. Let's say we had some sort of entry here around $37,900, and we saw overall we're seeing this ascending pattern, and we're assuming that maybe we saw some sort of indication or some sort of price pattern that suggested, hey, there's going to be upside. Well, where could price go? Well, here's the highest point generally. If we were to produce a higher high, it would go past this. So maybe we would set our profit target to about 39,000. We could even set it just right at 39,000, which would have been around here, and that still would have been a valid profit target area. Now, if we wanted to set up a stop loss, which we should be, where could price go that would invalidate this trade idea? Well, looking backwards, if we entered here, even if we didn't see that this happened, if we look back considerably, this line, this level, as we see here, price very frequently struggled to come above this. We saw it here. This acted as support in this area. We're not looking at the whole chart, just a specific moment. Price bounced off of here, fell through. This acted as resistance on this push here, resistance again, resistance again, resistance again. It comes up. We could argue that this is support over the area. It comes down to here and then fell below. So this is a significant area. Now, if price were to fall below on my entry, would it fall even lower? Arguably, maybe not. Generally, we are seeing higher lows. We saw a low here. We're seeing consecutive lows in an ascending fashion. Here we see two more lower lows because price failed to break past this level. But generally, these are higher lows compared to here. So looking in the macro trend, right now we're looking at the 1 hour. Generally, there were ascending lows at this time period. So we're going to set our stop loss around here. So this will give us a 2% stop, a 2% risk for a 4% reward. So this gives us a 2R, where for every point or every percentage of risk we take on, we stand to gain 2. Here's another example with a long entry. This is on Ethereum. So this entry was about $2,297. We could say 3,000 if we want to just have a solid rounded figure. We have our target profit around here, which would be about 3,200. And the key here is we see our profit target of being 9% of about $3,270 with our stop loss at 3%. We figured, all right, we're going to long off this candle, and if it comes back down to here or maybe even lower, my idea is lower. Maybe this was a quick scalp. And here we see our stop loss is 3%, our profit target is 9%. This is a 3-to-1 risk-reward ratio. For every 1 point of risk I take on, I stand to gain 3. So 9 divided by 3, 3R. So once again, this is a fairly lower risk trade, right? We stand to gain much more than compared to if we're wrong. If we're wrong, we lose 3%. If we're right, we gain 9%. Here's an example of a 2-to-1 risk-reward ratio trade. Let's say we took some sort of long position here. We saw how price struggled to come above this level. It acted as support over here. It came up, comes back down, wicks down. This is a significant level, a pivot level, if you will. This is on Solana, US dollar, on the 1 hour chart. So let's say we opened up some sort of position in this area, and we're thinking, all right, where could price go? Well, if I'm right, and I'm seeing these ascending lows, these higher lows gradually increasing, well, realistically, price could go back up to here. We established this recent high of about 114. Let's see. Well, if I want to be conservative, at least maybe my first profit target, maybe I'm going to take increments of profit. I'm not going to take it all here. That's another strategy. But what we could do is we could measure this out and say, well, this whole line, this whole market movement, this pattern here, it really struggled to come below this area. This could be seen as some sort of neckline, if you will. So maybe I want to set my profit target at that neckline, which would give me a 7.11 percentage increase, or my 7.11 reward. Now, below this, looking below this, let's say I open this trade around here, price struggled to come below this area, which also lines up pretty well with this price pattern here. We saw Solana ranging, with moving within this range, consolidating before falling below this price level, about $93 on Solana. So let's say we want to set our stop here, because if price does come and fall below this line, as we saw here, it's going to come down even lower to $90, which would be an even bigger drawdown. So what we could do is we could set our stop loss here, theoretically, right? That way we're protected in case price does fall and the support level doesn't hold. But we still stand to gain much from this, right? We are at least getting 7% if we're right. And if we're really right, price could come back up to these highs to 112 or maybe even higher. As we saw, it did do that. But if we're pretending that none of this happened, where none of this side of the chart really exists, none of this happened yet, realistically, this makes sense. We can at least reach this neckline of this price movement, and even better case scenario, we retrace back up to this 114 and we're making even more profit. So the main concept of risk-reward ratio is to look for opportunities that you stand to gain much more than what you stand to lose, right? We want to stick with those higher reward to lower risk ratios. Now, this idea is called an asymmetric opportunity, where the potential upside is greater than the potential downside. We stand to win much more than what we stand to lose by entering that trade. Now, win rate is another factor to consider when cultivating a risk management strategy. Win rate is the percentage of how many trades are winning trades over a period of time. Now, the win rate would be equivalent, if we want to calculate this would be the winning trades dividing by the total trades, and then you would multiply that by 100. So an example, let's say a trader made 25 trades in the month of November, and 16 of them were winners. We could do the math where 16 divided by 25, and then we multiply that by 100. This would equate to a 64% win rate. Now, going along the concept of win rate, traders can often be split into two different categories. Higher R, lower win rate setups, where you win big but not as often, so higher reward setups. Where lower R, lower reward, but higher win rate setups means that you win smaller but you win more often. Now, generally, people tend to pick one or the other. Once again, there's no need to pigeonhole yourself. If you feel like there's situations where having a higher R but a lower win rate setup might be more beneficial to you, that's a specific strategy. I would find it a successful strategy and stick with that and not just flip-flop between strategies just because something went wrong. Trading does take time. But generally, we do find traders split into these two different categories. I opt for lower R but higher win rate setups. I prefer to compound things. I don't like to take on a whole ton of risk. And for me, it feels good to have a higher win rate percentage compared to not winning as often. But everyone's different. That's subjective. Now, by knowing your average R, this is done by tracking it through a trading journal, which we'll talk about how to set up in a little bit. Traders can calculate the minimum win rate that they need in order to be profitable. where you would use this formula: 1 divided by the sum of 1 plus r, and then multiplied by 100. So a trader's journal shows that they have an R of 3. So for every point of risk that they take on, they're standing to make 3 reward. So if we do the math, 1 divided by the sum of 1 and 3, 4, and then that would be 0.25 multiplied by 100 would give a 25% win rate. Now, in order to quickly go through these win rates, in case you want to figure out what kind of win rate you need to have in order to figure out how am I going to be profitable. Here is a win rate cheat sheet in case you don't want to do the math on every single R multiple or risk multiple. So here we see multiples of 0.5. You would need to win 67% of your trades in order to be profitable. If you have a 1-to-1 ratio, you need to win 50% in order to break even. A 1.5 R multiple, risk to reward multiple, you need to win 40%. 2 risk to reward, you need 33% win rate, and so on and so on. Now, if you notice, the higher risk-reward ratios, where you're getting more reward out of the amount of risk you take on. So if you're taking on 3 or 3.5 reward for every 1 point of risk, you don't have to win as often, because if you're wrong, it doesn't necessarily hurt you, right? As long as you're taking on those wins, if you're right for those few times, you're making up those losses and more. You only need to be correct 22% in order to break even and make profit with a higher reward ratio.